Did you know that entrepreneurs can save up to $100 million in capital gains taxes when they sell their business? Yes, Congress created a strategy that can save you up to $100 million in capital gains taxes. Now you're probably asking yourself, how can I use this in my business? So in this video, I want to share what the strategy is, who qualifies for it, and how you can qualify for it. See, we met a few people that could have saved millions of dollars in capital gains taxes when they sold their business. Now, if you're like many entrepreneurs, you probably haven't heard of this. Many times it's because they rely on a CPA that's only focused on tax preparation and doesn't take the time to learn the strategies in the tax code. We love that adage that a smart person learns from their own mistakes, but a wise person learns from the mistakes of others. If I haven't met you yet, my name's Chris Wilbratte, and I'm co-owner of Echelon Financial and Osborne Morano Getson CPAs. And we can only work with a select number of entrepreneurs and business owners. So we created this channel to hopefully help a lot more people. The strategy I'm talking about is Section 1202 of the IRS Code, also known as Qualified Small Business Stock. It's a special type of stock that excludes gains from a sale of your business. Many entrepreneurs focus on strategies that lower their income taxes, which is smart. But Section 1202 is an exit strategy, and it has been part of the tax code since 1993. In fact, Congress has sweetened the pot several times by increasing the potential savings. So let's talk about what it is and how it works. There are two tiers of exclusions. The first is an exclusion of up to $10 million of the sale of your business. Because capital gains taxes cap out at 20%, you can save up to $2 million in capital gains taxes. You qualify for this whether you invested $1 or $1 million. The second tier is the maximum gain amount that can be excluded. This is calculated using your adjusted basis. You can exclude up to 10 times your basis from capital gains taxes. Your basis is the value of the assets you contributed or services that you provided or cash you used to purchase shares. This is going to get complex, so I'm going to share some examples with you. In this first example, your exclusion is $10 million. Remember, whether you invested $1 or $1 million, your exclusion is $10 million or 10 times your basis. In this example, your basis is high enough that you will use the 10 times your basis and you would save $6 million in capital gains taxes for their cash investment. And I want to point out here that your ownership percentage of the company is irrelevant for these calculations. You could own 1% or 100% and the calculations would still be the same. This example shows how you could receive stock for services rendered, and because the value of your contribution was $1.5 million, you could save up to $3 million in taxes. And finally, an example of someone who contributed property that saved them $16 million in taxes. So as you can see, there are millions of reasons to consider using qualified small business stock to save on capital gains when you sell your company. So what are the terms and conditions to use Section 1202? Here are the terms and conditions for using Section 1202. The key points on this slide are the 5-year holding period for the stock, that the fact that you must receive the stock directly from the corporation and not from a secondary market or another person. And finally, the sale of the business must be a stock sale. Potential disadvantage of a stock sale is that the buyer can't depreciate the purchase, which means they pay more taxes on the purchase because they can't use depreciation to lower their future tax liability. And the buyer inherits all the past and future liabilities of your business. So they'll be taking on more liability than if they did an asset purchase. Let's look at the historical gain exclusion percentages. As you can see, the percentages of the sale that can be excluded from capital gains has increased from the original 50% in 1993 to 100% in 2010. And in September of 2010, Congress protected the exclusion amount from the alternative minimum tax. Based on these numbers, it seems that starting a qualifying business is something that Congress wanted to incentivize through tax policy, as governments often do. So what type of businesses qualify? Well, let's look at the criteria. So first, at least 80% of the assets of the business must be used in the active conduct of one or more qualified trades of the business. Now, since the IRS hasn't published much on who does qualify, let's first look at the type of businesses that don't qualify. The qualified trader business is anything that is not one of these examples. And so basically, it's any business where the principal asset is the reputation or the skill of one or more of the employees. And also anything in banking, leasing, production, or extraction business eligible for depletion allowances, or any of these types of businesses as well are excluded. So you might be thinking to yourself, what does qualify? So we were able to find an IRS private letter ruling for for a company that qualified for Section 1202 stock. And this is what the private letter ruling said. See, this company offers data migration and management services to business, so it doesn't sell any software or equipment, and any advice they provide is related to the prospective customer's needs, but it's ancillary and supports the sale of the implementation of the work their employees perform. They don't bill for counsel or advice, but only for data management solutions. And this last point is key, in that the company does not engage in a trade or business involving the performance of service in the field of consulting. So in this case, the data management is their offering, not the consulting on how to use the data management service. And if you like this, it would be helpful if you could hit the like button or subscribe button. This last point I want to share with you isn't part of Section 1202. It's an estate planning idea for how to use the maximum gain exclusion to avoid estate taxes. When you're creating the kind of wealth from the sale of a business, legacy often comes into play. And a big part of legacy is protecting your assets from the estate tax rates of up to 40%. So let's pretend that your basis on the investment in this business is $10 million, and you have a large taxable estate. Now, you want to avoid estate taxes on the sale of your business or an investment that you made in a business. Now, because estate tax calculations will be on the amount that you gift to your children, you could give $5 million of stock to your children. Your basis on Section 1202 stock transfers to the recipient of the gift. Now, on the sale of the business, your children could receive up to 10 times their basis, or $50 million in exclusions on this gifted stock. This could potentially eliminate or significantly reduce one of the biggest downsides of lifetime gifting for estate planning. Paying for estate taxes on $5 million is a lot less than paying the estate taxes on $50 million. It's a lot like a farmer paying taxes on the seed rather than the crop. So in conclusion, this video is intended to give you a high-level overview about what's possible, and there are many nuances on how this may apply to your business. We've been helping entrepreneurs for many years grow and protect their wealth. So if you're curious about what else you might be missing out on, go to our website and click Start Here.